Hello, everybody, and welcome to the Like a Tortoise channel. Very happy to have you join us. Once again, if you are new here, welcome. And if you are not, thank you so much for all the ongoing contribution and for the great feedback that I've received. Cheers to you guys. Many thanks indeed. I want to update you all on our largest portfolio holding, and that is Alibaba. Alibaba reported earnings yesterday, and as you probably know, I was very curious to see exactly how things are flowing at the company, because I know they have been making a ton of investments in order to remain competitive and to expand their competitive advantage. So, without further ado, let's jump right into today's video, and I'm going to tell you whether I'm buying more, I'm selling, or I'm doing nothing, which is something that I love doing, just nothing. Okay. So, our largest portfolio position, there are great things about this report and conference call. And today, this is exactly what I discuss. As always, I put everything in a Word document, and I will be sharing this as well with our community members. So if you want this report, entirely free, just leave a comment or reach out to me on WhatsApp. In fact, I always put the school community link in the description. It's free to join, so if you guys want, you can join it. But what I will also do is I will also add my WhatsApp number, and hopefully I will add you guys to the free WhatsApp community as well. So okay, let's just discuss this because we have quite a bit to walk through. So. First of all, Alibaba, my largest holding, delivered the mixed but strategically important Q3. Revenue beat expectations while EPS missed, and the stock closed flat after briefly rising about 4% post-earnings. In fact, I think at one point, the stock was actually up almost 4%. Almost 5%. But so, what caused the stock? What caused the stock to give back some of its gains after end of day? Beneath this, what happened is that first of all we saw some selling pressure. But in all fairness, I don't care about that, as you know, because I'm always paying attention to the long-term picture. And what I can say in simple terms is that the long-term picture remains unchanged. If anything, it has been made stronger. So, beneath the surface, however, this quarter reinforces a crucial shift. Alibaba is no longer just an e-commerce giant. It's rapidly evolving into a full-stack AI company, a transition that over time should command a higher valuation multiple. Okay, this is very important. And this is part of the reason I continue to be very bullish on this company, is that yes, we are up some, 80-90% on our position. That's great. However, this company remains staggeringly cheap, remains incredibly cheap compared to its closest competitors, especially those its Western peers. And we will talk more about valuation going forward on a relative basis. But it's part of the reason why I still believe there is more upside. Okay, so key takeaways in one line: Alibaba is deliberately sacrificing short-term profitability to fund AI infrastructure in instant commerce expansion and accelerating revenue, which is something that we are seeing, suggests these investments are beginning to bear fruit. So let's break down the main financial highlights year over year, and then I also added two tables. The first one that sets forth a breakdown of the revenue by business segment, as you can see right here. And the next one below sets forth a breakdown of the adjusted EBITDA by segment. Okay. So, let's continue. Let's scroll up. Okay, so financial highlights. Revenue. Reported revenue was up 5% year over year. This is, it's above analyst expectations for 3% revenue growth. So I think, that alone shows improvement. But adjusted for disposed businesses, namely Sunheart and InTime, like for like revenue would have actually grown 15%, a far more accurate reflection of underlying momentum. This, while everybody seems to be focusing on this 5% over year growth, I pay most attention to these ones. They disposed of these unprofitable businesses, Sunheart and InTime, right? So that's great news. I mean, if they are not delivering on expectations, then I think the company did well by just selling by just selling them, and sure enough, we are seeing that yielding some results. Okay, what did they use with some of the money that they made from selling both these businesses? They reinvested that back into the company, namely AI investments and instant e-commerce. Okay. These disposals help fund strategic reinvestments into AI and cloud infrastructure. I like that. So if these ones are not delivering profits, let's just sell them and focus on what really matters, what really is going to bring profitability over time. Profitability pressure. This is when I started looking at the report, I saw, oh my God, profitability took a substantial hit. Okay, and we have to take that into account because we can't be fully biased. We always need to weigh in the do's and the don'ts. And while by and large I'm positive, okay, I think this was a strong report because we can see revenue across their business segments to improve substantially, which is always very good for a company that was labeled uninvestable and dying business a few years ago. Okay, however, we can see that they are growing at the cost of profitability. And if you look at the income from operations, it tumbled 85%, adjusted EBITDA tumbled 78%, net income tumbled 53%, non-GAAP EPS 71%. This was a big hit. And sure enough, understandably so, exactly because profitability took such a big hit, margins compressed. Look at the operating margin. Down, only down to 8% compared to 15% last quarter. Compared to 15% last year. You can see that adjusted EBITDA margin. Well, actually, this is wrong. Yeah, so this is operating margin was down 8% versus 15% last quarter. Adjusted EBITDA margin 10% versus 18%. Adjusted EBITDA margin 13% versus 21%. Margins are getting squeezed, but as I will explain to you, the business really has no choice. They have to do this in order to remain competitive, or they are going to be, or their moat will be under pressure. And sure enough, margin compression is something that we are seeing across businesses in tech space, namely the AI hyperscalers in the US, the likes of Nvidia, the likes of Amazon, Microsoft, and so on and forth. Okay, so they have to do this. Cash flow and capex. Look at net cash from operations declined 68%. Free cash flow saw an outflow of 21.8 billion. This deterioration reflects aggressive AI infrastructure and instant commerce investments. We are seeing cost pressures as well. Look what happened to sales and marketing. They rose 26.6% of revenue to almost 27% of revenue compared to 13.5%. In fact, if I show you the report right here, you can see exactly that. Let me just minimize this. Let's see, look at sales and marketing expenses, excluding share-based compensation. Let me zoom in on this. And you can see that compared to last quarter, compared to the same quarter last year, look at that, from 30.5% to 26.6%. Look what happened to cost of revenue, excluding share-based compensation. It remains pretty much the same, 60.6% versus 60.7%. I like to see that. Look at product development expenses. increased slightly from 5.3% to 6.3%. Nothing concerning. It remains pretty flat. Same with cost of revenue. And in general, in administrative expenses, excluding share-based compensation, actually saw a decline from 3.6% to 2.6%. And they pointed out to efficiencies, and these efficiencies have led them to actually lower these expenses. So part of the investments they are making, right, are already bearing fruits, and that comes in the form of lower general and administrative costs. However, sales and marketing took understandably are higher, as I explained here in as I explained here. These ugly numbers represent deliberate strategic reinvestment, not structural weakness. The pressure comes from user acquisition and improved experience investments across China e-commerce. In fact, during the conference call, management highlighted this, and I should be underlying this across China e-commerce. Increased user acquisition and improved experience investments across China e-commerce. Very, very important. Okay. Look what happened to share-based compensation. You know, I don't like share-based compensation. And sure enough, share-based compensation decreased 20% year over year. What I really like about that, in fact, if I go here to share-based compensation, SBS, is this thing here? Yeah, right here. No, this is share repurchases. I don't want to see that, so it's on the other. It's on the other report that they delivered. But never mind, I have it here. You can see that the share-based compensation decreased 20%, reflecting something that the company has started doing a few quarters ago. They are creating more cash incentives. So instead of just rewarding employees and management teams via through issued shares, what they are doing is they are betting on long-term cash incentives, which of course offers a more disciplined approach to talent costs. Okay, so they see great talent, fantastic, here is cash, maybe bonuses, for example. But what they don't want to do, in fact, what they are doing is they are lowering share-based compensation, which means shareholder dilution is actually decreasing, which is a very good thing. Okay, awesome. Segment performance. Let's break down the business segments and see what we have. Look at Alibaba China e-commerce group. Significant improvement in e-commerce business, in quick commerce unit economics. This is very important. Okay, strong customer retention and higher average order values. This is key, guys. What does that mean? It means that people are no longer staying on the platform longer, right? So they are retaining existing customers. But what's happening as well is that the average order volume is actually increasing. So this means customers are buying so they are ordering larger. They are spending more, yeah, per order, which is obviously very good, right? Accelerated onboarding of Tmall brands and customer management revenue was up 10% year over year. Rapid growth in Taobao monthly active users. So you can see that the company, this segment, which is by far the one that drives which is the one that contributes more profits. Okay, this segment that has been stagnant for such a long time now is once again back in growth mode, and I like to see that. Okay. And the results of all the investments are seen as you can see in customer retention, higher average order volumes, and rapid growth in total monthly active users. This is all very important. Alibaba International Digital Commerce revenue was up 10% year over year. It declined slightly compared to last quarter, but still very positive. Achieved for the first time in many quarters positive adjusted EBITDA. This has been a drag on profitability. However, it reached break even last quarter, and now it has become positive, and this will begin to contribute more and more to the company's overall profitability, which is something that I really like. Okay. What about cloud? Look, cloud obviously was the standout. Everybody was focusing on cloud intelligent group segment because of AI and all of that. And sure enough, the company delivered on those expectations. Revenue was up 34% year over year versus 26% last quarter, which was already very good. But now it's accelerating. I love seeing that. Okay. Look at the adjusted EBITDA, up 35%. This is a segment that is growing revenues at a very fast rate, and profitability is also exploding. Sure enough, look at this. AI-related revenue grew triple digits for the 9th consecutive quarter. Strong enterprise adoption of AI services, growing use of coding assistants and value-added AI applications. Management confirms that current AI demand exceeds capacity. They mentioned this so many times during the conference call. They cannot meet ridiculously high demand. Okay, AI demand exceeds capacity. So this confirms cloud as Alibaba's most powerful long-term growth engine. Now, what is the company doing in order to meet this exceeding capacity? They have to ramp up capex. They have no choice. Imagine a customer that just keeps asking you, oh, Ed, I mean, do you have more of this? Do you have more of that? What are you going to do, guys? You need to keep producing. The more you produce, the more revenue you generate. Margins come at a later stage. Okay, but right now, because the company has a lot of reinvestment, has a lot of growth for reinvestment. Sorry, has a long runway for growth. They have to keep reinvesting to meet that exceeding growth. Okay, so this confirms. Okay, we already discussed that, and look at the segments right now. Look at that. So Alibaba China e-commerce group. Look at this growth across the board. Okay, 10% direct sales, logistics, and others 5%. Quick commerce 10%. Well, actually, quick commerce. Let me see. Quick commerce was right here 60%. China commerce wholesale 13%. Overall, Taobao Alibaba China commerce group 16%. Look at cloud, our 35%. You can see that all others was a decline of 25%. These include all the other segments like Kainao, which is the logistics platform, in other businesses like movies and so on and forth. Okay, so this is a behemoth. They are a big conglomerate with many business segments, but these ones that are here are by far the most important ones. Okay, and many of the other segments are still they are still growing, but growth has declined compared to previous quarter. And what about in terms of profitability on an EBITDA basis? You can see that the standout performer was, of course, Cloud Intelligent Group, growing by 35%. Look at what happened to all the other segments. Okay, negative. Why is it negative? Again, because of the investments that the company has been making, mostly in instant commerce and AI infrastructure. Okay, so what about management commentary? What were the main themes that I managed to note down? Look, they mentioned this many times. We are not able to keep pace with demand for AI. AI demand conviction remains robust. Focus on improving quick commerce unit economics, okay? User engagement and retention exceeding expectations. This is very important. That's why I underlined it. CapEx may exceed prior 380 billion guidance. Needless to say, the drag on profitability will continue over the next few quarters. I don't expect, especially after this commentary, if they continue to see explosive demand, that they will have to increase capex to satisfy that demand, and that's why you are seeing net, for example, you are seeing cash and cash equivalents decline, and also free cash flow, which has taken a significant hit. Okay, management is clear. This is an aggressive investment phase aimed at long-term dominance. Okay, when a company has a moat, it cannot afford to rest on its laurels. That said, I agree. Some companies operating in less competitive industries don't need to reinvest a lot into growth. But remember one very crucial thing, guys, and I took the liberty to actually take a screenshot. Over the very long term, okay, I want you all to focus your attention on this right now. Over the very long term, if you look at this is the S&P 500 going back to the 1990 all the way through 2009. Top line growth, the long run driver of stock performance. What you can see right here, guys, is that revenue is the key driver of long term stock performance. All right, it's not free cash flow, it's not multiple expansion, it's not margin expansion. No, it's revenue growth. Over the short term, you have more important factors like multiple expansion, as you can see right here. However, if the company continues to drive more revenue over time, then that is what's going to fuel shareholder long-term stock performance, because ultimately that should, if the company is of course efficient as well, then ultimately that should turn into that should start contributing to profitability. Okay, very important for you to see that, and this is exactly what I think will happen with Alibaba. Is that while they should accelerate the revenue growth, they should regain market share in the core markets they operate in and focus on margins later at a later stage. Okay, awesome. So let's minimize this and go back here. CapEx versus investor concerns. Alibaba's heavy CapEx has pushed free cash flow negative, about 3 billion, right? Mirroring concerns seen across global big tech. This is part of the reason why the company, in my opinion, gave back some of its early gains, is because people they just looked at the profitability that took a hit, and they look at the company's cash position and the free cash flow that all of them are have been well used up, of course, and so because they don't understand the company, again, it goes back to understanding the business. They fear that this they fear that this instead of creating more value over time will actually weaken their moats. I completely disagree. Demand is exceeding current capacity once again. This phase is essential to ensure the company remains the number one AI provider in China. Near-term spending lays the groundwork for future cash flows. All right, very important. And sure enough, if you look at other companies like Amazon for many years had negative free cash flow while the revenue was just exploding. And sure enough, if you even look at the company's financials today, you can see that, I mean, you shouldn't value a company like Amazon based on free cash flow, exactly because it's quite volatile. The company continues to reinvest back into growth opportunities, which will unlock future value. And this is exactly where I believe Alibaba falls. This is not reckless spending. This is strategic capacity building. Let's talk about the instant commerce category, which together with AI is seeing big reinvestments here. And you can see that Alibaba is investing billions to secure dominance in China's instant commerce space. While this is compressing margin, The logic is clear. Protecting user mind share today protects future high margin revenue. Losing users right now would weaken Taobao's long-term monetization power. Instant commerce growth may become Alibaba's next significant growth engine together with what? AI and cloud. The company is already seeing results from its prior report. What did management say? Our significant investments in quick commerce contributed to a 25% year-over-year increase in monthly active users on Taobao in the first 3 weeks of August. This is tangible results. So it's a defensive and offensive strategy rolled into one, and a necessary one. What will happen if they don't? What will happen if they don't strengthen their moat? Competition, namely from the likes of Meituan, I think that's how you pronounce it, will just will steal a lot of will steal more of their market share by stealing customers. Okay, what about valuation? What is fascinating is that despite the company having multiple exits, many business segments, right? So you no longer just have e-commerce, you also have an AI behemoth here. And despite its AI transformation, the company still trades at only 18 times earnings. This is crazy. Look at book value, 2.6 times book value. If you look at some of its common peers, for example, like Amazon, let's have a look at Amazon just to show you exactly the discrepancy between these companies valuation-wise. If you look at a company like Amazon, let's have a look at ratios in the trailing 12 months. Look at the PE ratio of the company. Where is the PE here? Look at that, 32 times. Okay, versus only 18 times for Alibaba. Look at the forward PE, 30.84 times. Okay, I mean it's staggering. Look at the price to book value, 6.63. Look at the price to sales. Do they have price to sales right here? About 3.52. Okay, so look, does Alibaba deserves a higher premium compared to Amazon? No, I'm not saying that, because it's important to understand that Alibaba is in China, and look, you have both country risk and company risk. Okay, however, to trade at such a big discrepancy, I mean, I think this is just mind-boggling. Okay, and I think that either Western valuations will have to come lower, or Alibaba valuation will have to, the multiple will have to expand, or we're going to see a mix of both. Okay, good. So what is my main take? Headline profitability looks weak, but the underlying fundamentals remain strong and increasingly promising. What matters most? Accelerating cloud growth, improving international segment profitability, strong user engagement metrics, evidence of operational leverage building, top line growth momentum, accelerating revenue today is a leading indicator of tomorrow's earnings power. We should begin seeing improved ROIs and margin recovery once this investment cycle matures. Yes, capex is elevated, but it's targeted, discipline, and strategically aligned with creating lasting moat. Final verdict: Alibaba quarter three confirms that the AI transformation is real and accelerating. Short-term financial pressure is strategic, not structural. Valuation remains compelling, even against the despite the fact that we are already up 80% on our position. The long-term investment thesis remain intact for patient long-term investors. This quarter strengthens, not weakens, the case for Alibaba as a holding in a high conviction portfolio. That's where we stand. Patient long-term investors, slow and steady wins the race. So many investors could be fleeing the stock after this report, after seeing profitability decline. we actually will take the opportunity to actually consider buying more should we see significant selling pressure. I mean, I don't know if that will be the case. And the stock, for me at least, the stock would have to come down substantially for me to actually buying more, because as you guys know, in my average cost per share is about 74, 75. This is, I don't think I will be adding more. I already have a very large position. However, if this thing faces selling pressure, then I will certainly consider buying. And that's it, guys. I hope you enjoyed this. Let me just jump to the Alibaba chart right here on eToro. I always use eToro for educational purposes once again, and I use interactive brokers to execute all of our transactions. Okay, but this is more user friendly, and you can see this is where we are. So from a technical standpoint, you can see that 75 is where I bought this thing, about 74, 75. We are here, and I believe while we may see some selling pressure, ultimately um, 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 the way will be so this thing will ultimately move substantially higher from its current levels, and I think my intrinsic valuation level sits at about 260, as you know. So we are not near that level, and so I'm sitting tight. I'm not holding any of my shares, and I'll keep you posted as always. Stay tuned for more. Smash the like button if you enjoyed the video. Let me know in the comments. Are you an Alibaba shareholder, and what are you doing with your holdings? Are you selling? Are you buying more? Let me know, and let me know if you found the video insightful. Thank you so much.